Welcome students in Finance for Engineers course. Over the last few lectures, we have understood how one can read and analyze financial statements. We will now focus our attention on analyzing these financial statements by using various ratios. The best way to analyze the financial statement is by studying the financial ratios. Financial ratios help interpret the results and compare with previous years and other companies in the same industry. Ratio analysis, the foundation of fundamental analysis, helps to gain a deeper insight into the financial health and the current and probable performance of the company being studied. For this insight, the analyst used the quantitative method where the information recorded in the company's financial statements are compared and analyzed. And there are certain formulas that are used for the same. Thus, ratio analysis describes the significant relationship which exists between various items of balance sheet and a statement of profit and loss of a firm. As a technique of financial analysis, accounting ratios measure the comparative significance of the individual items of the income and position statements. Comparative data and analysis can give an insight into the performance of the business over a given period of time by comparing it with the industry standards. At the same time, it also measures how well a business racks up against other business functioning in a same sector. It also helps to assess the profitability, solvency, and efficiency of an enterprise. Thus, it helps to make a qualitative judgment about the financial performance of the firm. A typical financial ratio utilizes data from the financial statement to compute its value. On its own merit, the financial ratio of a company conveys very little information. For example, assume Ultratech Cements Limited has a profit margin of 15%. How useful do you think this information is? Well, not much, really. 15% profit margin is good, but how would I know if it is the best? However, assume you figure out ACC Cement's profit margin is 12%. Now, as we are comparing two similar companies, comparing the profitability makes sense. Clearly, Ultratech Cement Limited seems to be a more profitable company between the two. Thus, we can see that the ratio makes sense only when you compare the ratio with another company of a similar size or when you look into the financial ratio trend. This means that once the ratio is computed, the ratio must be analyzed either by comparison or tracking the ratio's historical trend to get the best possible inference. Now, the next is uses of ratio analysis. It helps to track the company performance, determining individual financial ratios per period and tracking the change in their values over time is done to spot trends that may be developing in a company. For example, an increasing debt to asset ratio may indicate that a company is overburdened with debt and may eventually be facing default risk. Second, it makes comparative judgment regarding companies' performance, comparing financial ratios with that of major competitors is done to identify whether a company is performing better or worse than the industry average. For example, comparing the return on assets between companies helps an analyst or investor to determine which company is making the most efficient use of its assets. Now, the next is types of ratios. Three different important types are there of ratios through which we can analyze the performance of the organization, efficiency of the organization. Efficiency can be judged in case of operating efficiency and management efficiency. So the first ratio is liquidity ratio, second is leverage ratio, third is activity ratios, and fourth one is profitability ratios. So let us start with liquidity ratios. Liquidity ratios measure a firm's ability to meet its current obligations. It includes current ratio, quick ratio, which is also called as liquid ratio or acid test ratio, and the third one is cash ratio. So, what is current ratio? The current ratio is the most frequently used ratio to measure the company's liquidity, as it is a quick and easy measure to understand the relationship between the current assets and current liabilities. It basically answers this question: how many rupees in current assets does the company have to cover each rupee of current liabilities? Formula for calculating current ratio is current assets divided by current liability. Let us see an example. Current assets are given rupees 200. It can be lakh, thousand, crores, whatever. And current liabilities is equal to rupees 100. Now, putting the figures into formula, we get current ratio 2 as to 1. It implies that the company has 2 rupees of current assets for every 1 rupee of current liabilities. Certain important facts are there which we should understand about the current ratio. They are: the current ratio provides us with a rough estimate of whether the company would be able to survive for 1 year or not. If current assets are greater than current liabilities, we interpret that the company can liquidate its current assets and pay off its current liabilities and survive at least for one operating cycle. The current ratio in itself does not provide us with full details of the quality of current assets and whether they are fully realizable. If the current assets consist primarily of receivables, we should investigate the collectability of such receivables. If current assets consist of large inventories, then we should be mindful of the fact that inventories will take longer to convert into cash as they cannot be readily sold. Inventories are much less liquid assets than receivables. Finally, the average maturities of current assets and current liabilities should also be looked into. If current liabilities mature in the next 1 month, then current assets providing liquidity in 180 days may not be of much use. Next is quick ratio. This ratio is also known as the quick ratio or the acid test ratio. Sometimes current assets may contain huge amounts of inventory, prepaid expenses, etc., which are not very liquid, and it affects on the liquidity position of the firm. To address this issue, if we reduce inventory and prepaid expenses from the current assets, then it provides us with a better picture of the coverage of short-term obligations. The rule of thumb for a healthy acid test index is 1. Formula is quick ratio is equal to current asset minus into bracket inventory plus prepaid expenses divided by current liabilities. That means we are excluding inventory and prepaid expenses from the current assets and dividing it by current liabilities. For example, current assets are given rupees 1,500 and current liabilities rupees 1,000. So the inventory is of rupees 300 and amount of prepaid expenses is rupees 150. Then quick ratio will be 1.05 as to 1. Certain important facts concerned with quick ratio. Inventories are first converted to receivables, which in turn take further time to convert into cash, and that's why it is called as less liquid assets. In addition, there can be uncertainty related to the true value of inventory realized, as some of it may become obsolete, prices may change, or it may become damaged. It should be noted that a low quick ratio may not always mean liquidity issues for the company. You may find low quick ratios in businesses that sell on a cash basis, such as restaurants, supermarkets, etc. In these businesses, there are no receivables. However, there may be a huge quantity of inventory. Now, the next is cash ratio. The cash ratio considers only the cash and cash equivalents. These are the most liquid assets within the current assets. Cash and cash equivalents include cash in hand, cash at bank, and marketable securities. If the company has a higher cash ratio, it is more likely to be able to pay its short-term liabilities. Formula for calculating cash ratio is cash and cash equivalent divided by current liabilities. So let us see example. Cash and cash equivalent is equal to $500. Current liabilities are $1,000. So here quick ratio will be 0.5 as to 1. Important facts concerned with cash ratio. All three ratios, that is, current ratio, quick ratio, and cash ratios, should be looked at for understanding the complete picture of the company's liquidity position. The cash ratio is the ultimate liquidity test. If this number is large, we can obviously assume that the company has enough cash in its bank to pay off its short-term liability. Now, let us see significance of liquidity ratios. The liquidity ratios provide a measure to assess ability of the firm to meet its current liabilities. The larger the current asset with respect to its current liabilities, better the firm will be able to meet its current financial obligations and safer the firm will be. Further, one thing must be remembered that adequate liquidity is always necessary for a firm to meet its current obligations, but liquidity more than requirement also not good as it reduces profitability of the firm. The importance of the liquidity ratios can be better understood when we look at the consequences. When a firm does not have enough liquidity to meet its current obligations, in such case the firm would lose its goodwill as well as credit worthiness and miss out on profitable opportunities. Now, the next type of financial ratio is leverage ratios. The leverage ratios are also referred as solvency ratios or gearing ratios. It measures the company's ability, that is, long term ability, to sustain its day to day operations. Leverage ratios measure the extent to which the company uses the debt to finance growth. Remember, for the company to sustain its operations, it has to pay its bills and obligations. Solvency ratios help us understand the company's long term sustainability, keeping its obligation in perspective. A leverage ratio indicates the level of debt incurred by a business entity against several other accounts in its balance sheet, income statement, or cash flow statement. For a company dependent on creditors, for example, to purchase inventory or fund capital expenditure, the unexpected cutoff in access to external financing could be detrimental to the ability of the company to continue operating. High leverage, significant reliance on external debt financing sources. Low leverage means operations are funded mostly with internally generated cash, that is, retained earnings. In general, increased amount of leverage in the capital structure equates to more financial risk since the company incurs greater interest expenses and mandatory debt amortization as well as principal repayments coming up in the future. But if a company opts to use very minimum leverage, The downside is that there are more shareholders with claims to the same amount of net profit, which will result in few returns for all equity shareholders. Next is there are two important leverage ratios. First is debt ratio, second is debt equity ratio. First is debt ratio. Debt ratio compares total debt to total capital employed or net assets. A high debt ratio indicates that the bulk of assets purchases are being funded with debt. This means that a business is operating with minimum level of equity. Formula for calculating debt ratio is total debt upon total capital employed or total debt divided by net assets. So how to calculate total capital employed? Formula is net worth plus total debt will give you total capital employed. For example, here is total debt given is rupees 2,96,500, which is the addition of short-term notes and long-term debt. Next information is concerned with shareholders' equity, which is also called as net worth. That is capital stock plus retained earning. And the amount given is 2,13,000. So by applying formula, we arrive at 0.58 as a debt ratio. Next is debt to equity ratio. Debt to equity ratio compares equity to debt and is calculated as total debt divided by total equity. Here, a high ratio indicates that the business owners may not be providing sufficient equity to fund a business. In other words, a higher ratio tends to indicate a greater level of risk to investors in the event of a bankruptcy or liquidation because bondholders and creditors get paid before shareholders. Formula for calculating debt equity ratio total debt upon equity. The example here is again the same total debt 2,96,500 shareholders equity given 4,13,000 and now debt equity 2,96,500 divided by 4,13,000 will give you 0.72. Next is activity ratios. Activity ratios are also called as efficiency ratios. Activity ratios are employed to evaluate the efficiency with which the firm manages and utilizes its assets. Also, to determine the efficiency of a business by using its liabilities and assets to boost sales and optimize profit. These ratios are also called as turnover ratios because they indicate the speed with which assets are being converted or turned over into sales. Activity ratios thus involve a relationship between sales and assets. Now, the first type of activity ratio is debtors turnover ratio is also known as accounts receivable or turnover ratio. It provides us the number of times account receivable is converted into cash sales. This ratio is an important indicator of a company which shows how well a company is able to provide credit facilities to its customers and at the same time is also able to recover the due amount within the payment period. High debt turnover ratio indicates that the credit policy of the company is sound, while a lower ratio shows a weak credit policy. Formula: receivables turnover ratio or debtors turnover ratio is equal to credit sales divided by average account receivables. Example: given information is total sales rupees 1000, credit given is 80%, opening debtors rupees 200 and closing debtors rupees 300. Now we have to apply a formula. So for that we require information concerned with credit sales. So first calculate credit sales, that is 80% of total sales. So the amount here of credit sales is rupees 800. Then average debtors we have to calculate. So how to calculate average debtors? Opening debtors plus closing debtors divided by 2 will give you an average debtors figure, that is rupees 250. And now we will apply a formula of accounts receivable turnover is equal to 800 divided by 250 will give you the answer 3.2 times. Next is debtors collection period ratio. This is also called as days receivable and it is directly linked with the account receivable turnover. Days receivable expresses the same information but in terms of the number of days in a year. This provides information about receivables collection days. Formula: debtors collection period is equal to number of days in year divided by account receivable turnover. Now for calculating debtors collection period, we must first calculate the debtors turnover ratio because that information is required for calculating debtors collection period. So let us see an example. The same example we are carrying forward here. So account receivable turnover is 3.2. Number of days in a year 365. So the days receivable here is 365 divided by 3.2 is equal to 114.06 days. It implies that it takes 114 days for the company to convert receivables into cash. That means this much time period company takes for collecting its receivables. Certain important facts concerned with this ratio: the number of days taken by most analysts is 365. However, some analysts or companies also use 360 as the number of days in the year. This is normally done to simplify the calculation. Account receivable days should be compared with the average credit period offered by the company. For example, in the above case, if the credit period offered by the company is 150 days and they are receiving cash in just 91 days, this implies that the company is doing well to collect its receivables. However, if the credit period offered is said 60 days, then you may find a significant amount of previous account receivables on the balance sheet, which obviously is not good from the company's point of view. Next ratio is inventory turnover ratio. The inventory turnover ratio means how many times the inventories are restored during the year. It can be calculated by taking the cost of goods sold and dividing it by inventory. A high stock turnover ratio is indicative of fast moving goods in a company, while low stock turnover ratio indicates that goods are not getting sold and are being stored at warehouses for an extended period of time. Formula: inventory turnover ratio is equal to cost of goods sold divided by average inventory. Calculation of average inventory, we will use a formula, that is opening inventory plus closing inventory divided by 2. Example: cost of goods sold rupees 500, opening inventory is rupees 150, and closing inventory given is rupees 100. So here, by using formula, we will arrive at inventory turnover ratio, that is 4 times. This implies that during the year, inventory is used up 4 times and is restored to its original levels. Next is account payable turnover ratio. It is also called as creditors turnover ratio. It is a measure of capability of the company to pay off the amount for credit purchases successfully in an accounting period. It shows the number of times the accounting payables are cleared by the company in an accounting period. For this reason, it is also known as accounts payable turnover ratio. A low payable turnover can indicate either lenient credit terms or an inability of a company to pay its creditors. A high payable turnover can indicate that a company is paying creditors too fast or it is able to take advantage of early payment discounts. It is best measured against credit purchases since it generates account payables. Formula: credit purchases divided by average creditors. Example: credit purchases rupees 1000, opening creditors rupees 250, and closing creditors rupees 300. Solution: average creditor. In the same way, we will calculate average creditors, that is opening plus closing divided by 2 will give you rupees 275. Account receivable turnover is 3.64 times. Days payable ratio, days payable or creditors payment period represents the average number of days a company takes to make the payment to its suppliers. Formula for that, creditors payment period or payable days is equal to number of days in a year divided by creditors turnover. So here we will use the same example for finding out payable days. Account payable turnover was 3.64. Creditors payment period here is 100.27 days. That means the company pays its clients every 100 days. Next ratio under turnover or activity ratio is asset turnover ratio. It is a comparison of sales to assets. This ratio provides an indication of how efficiently the assets are being utilized to generate sales. Total assets refer to all the assets that are reported on a company's balance sheet, both operating and non-operating, that is, current and long term. A high ratio indicates that a company is using its total assets very efficiently or that it does not own many assets to begin with. A low ratio indicates that too much capital is tied up in assets and that assets are not being used efficiently in generating revenue. Formula for calculating asset turnover ratio is total sales divided by average total assets. Example, sales of the company rupees 900 million, opening total asset 1.6 billion and closing total asset is 1.8 billion. So again here also we will calculate average of total assets, that is 1700 million, and then we will put the figures into the formula and we will arrive at the answer 0.52 as asset turnover ratio of the company A. Next is working capital turnover ratio. This ratio is helpful in determining the effectiveness with which a company is able to utilize its working capital for generating sales of its goods. If a company has a higher level of working capital, it shows that the working capital of the business is utilized properly. And on the other hand, a low working capital suggests that business has too many debtors and the inventory is unused. Formula, working capital turnover ratio is equal to sales or cost of goods sold divided by working capital, where cost of goods sold is equal to sales minus gross profit and working capital is calculated as current asset minus current liability. Let us see an example. Net sales 5 lakh, current assets 10 lakh, current liabilities 7 lakh 50,000, And here we have calculated first working capital, that is current asset minus current liabilities, that is rupees 2,50,000. Then working capital turnover ratio is 2. Various activity ratios here we have calculated, that is concerned with debtors, inventory, creditors, net assets, and working capital. So these are very important indicators which help us to understand the operating efficiency of the business. It also shows the way in which revenue is generated in a company and the way in which the elements of balance sheet are utilized for managing the business. So here I'm ending my session, and in the next lecture we will discuss the remaining part of ratio analysis or financial ratios is profitability ratio. There are various ratios we need to calculate to understand profitability of the organization, which help us to understand the operating efficiency of the management and what returns they are giving to their equity shareholders or investors. So here I'm ending session. Thank you.